There is a question that almost nobody asks out loud, but that sits quietly in the back of the mind of every person who has ever watched someone else get extraordinarily wealthy while doing what appears to be absolutely nothing. The question is this: why don't they sell? You watch someone accumulate real estate, stocks, businesses, land. The values go up dramatically, sometimes by millions of dollars. And they just hold. They do not cash out. They do not take the profit. They do not sell the apartment building that is now worth 3 times what they paid for it and put the money in the bank. They just keep holding, and somehow, impossibly, they keep getting richer while the person watching them keeps working harder and harder just to stay in the same place. This is not accidental behavior. This is not stubbornness or indecision or emotional attachment to assets. This is a deliberate, mathematically precise strategy that is the single most important difference between how wealthy people relate to money and how everyone else relates to money. And once you understand it, truly understand it, not just intellectually, but in a way that changes how you make decisions, your entire relationship with money and assets will shift in a way that cannot be undone. Stay with me through this entire video, because what I am going to show you is not a stock tip or an investment strategy or a list of assets to buy. It is a fundamental principle of how wealth actually works. One that the financial industry has very little incentive to explain clearly, because the moment you understand it, you stop doing a lot of the things that make other people rich at your expense. Let us start with the most basic question. When you sell an asset, what actually happens? On the surface, the answer seems obvious. You had an asset. Now you have cash. You converted one thing into another. Simple transaction, clean outcome, money in hand. But here's what actually happens beneath the surface. And this is the first block that everything else in this video is built on. When you sell an asset that is appreciated in value, 3 things happen simultaneously that most people never fully account for. The first thing is that you trigger a taxable event. In most cases, selling an appreciated asset means paying capital gains tax, either 15% or 20% for long-term gains, depending on your income bracket, or up to 37% for short-term gains if you held the asset for less than a year. On a $500,000 gain, that is potentially $75,000 to $100,000 going directly to the government before you see a dollar of it. The second thing is that you stop the compounding. The asset you just sold was not just worth what you sold it for today. It was worth everything it would have continued generating and appreciating in the future. When you sell a property that was generating $2,000 a month in rental income, you do not just lose the property. You lose every month of rental income it would have produced for the rest of your life. When you sell a stock position that has been compounding at 10% per year, you do not just take the profit. You terminate the compounding engine that was silently building wealth in the background. The third thing is that you face the reinvestment problem. Now you have cash. And cash, as we have established in previous videos, is losing value to inflation every single day it sits still. So you need to reinvest it, which means finding another asset at current market prices that can generate the same or better returns as the asset you just sold. And in most cases, the asset you just sold appreciated precisely because it was a good asset, which means finding something equally good at current prices is not guaranteed. And the transaction costs and taxes you paid in the process have already put you behind before you even start. This is the first reason wealthy people do not sell. Not because they are emotionally attached to their assets, but because the act of selling is mathematically more expensive than most people realize, and the act of holding is mathematically more powerful than most people appreciate. Now, let us go deeper, because the tax argument alone, while compelling, is only the beginning of why the truly wealthy treat their assets as permanent holds rather than things to be converted into cash when the price is right. The deeper reason connects to something called the stepped-up basis, and this is one of the most powerful and least discussed wealth transfer mechanisms. in the American tax code. Here is how it works. When you buy an asset, a stock, a piece of real estate, anything that appreciates your cost basis is what you paid for it. If you buy a stock for $10 and it goes to $100, your cost basis is $10 and your gain is $90. If you sell it, you pay capital gains tax on that $90 gain. But if you hold that asset until you die and pass it to your heirs, something remarkable happens under current tax law. Your heirs receive the asset with a stepped-up basis, meaning their cost basis is reset to the fair market value at the time they inherited it. If the stock was worth $100 when they inherited it, their basis is $100. If they sell it the next day for $100, they pay zero capital gains tax. The entire $90 gain, the gain you spent a lifetime accumulating, passes to the next generation, completely free of capital gains tax. This is not a loophole. It is not a tax dodge. It is a feature of the American tax code that has existed for decades and that wealthy families understand deeply and structure their entire financial lives around. Hold the asset. Never sell. Pass it to the next generation with a stepped-up basis. The wealth compounds tax-free across generations. And each generation inherits not just the asset, but the accumulated gains of every generation before them, without ever having paid capital gains tax on any of it. This is why wealthy families in America talk about assets in terms of generations, not in terms of years. They are not asking whether this stock will be worth more in 5 years. They are asking whether this asset will be worth more in 50 years. Because they understand that the holding period is not a constraint. It is the strategy. But here's the part that makes this entire system even more powerful, and the part that genuinely challenges the conventional wisdom about how money and assets work. Wealthy people do not sell their assets to access the value in those assets. They borrow against them. This concept is so important and so misunderstood that I want to spend real time on it, because it is at the heart of how the truly wealthy use money in a way that is fundamentally different from how everyone else uses money. Here is the basic mechanism. You own an asset, let us say a real estate portfolio with $5 million. You need $500,000 in cash for a new opportunity, a business, investment, or simply to fund your lifestyle. You have two options. Option 1. You sell $500,000 worth of your real estate. You pay capital gains tax on the appreciation. Let us say after tax you net $400,000. You'll no longer own that portion of your portfolio. It is no longer generating rental income. It is no longer appreciating. The compounding engine for that $500,000 has been permanently terminated. Option 2. You go to a bank and take out a $500,000 loan, using your real estate portfolio as collateral. The interest rate on this loan is low because it is secured by a high-value asset. Let us say 4% to 5% per year. You now have $500,000 in cash. You have paid zero taxes because you did not sell anything. You still own your entire real estate portfolio. It is still generating rental income. It is still appreciating. And the rental income from the portfolio is likely covering or exceeding the interest payments on the loan. This strategy, which wealthy people, financial institutions, and major corporations use constantly, is sometimes called by borrow die. You buy assets. You borrow against them to access cash without selling, and you hold them until you die, passing them to your heirs with a stepped-up basis that eliminates the capital gains entirely. The loan is never really repaid from income. It is eventually repaid from the estate, either by the heirs who refinance it, by selling a small portion of the inherited assets at the stepped-up basis, or by the ongoing income the assets generate. And because the assets have been appreciating the entire time, the loan as a percentage of the total portfolio value has been shrinking, even as the nominal debt remained constant. This is not a strategy available only to billionaires. Smaller versions of this exact mechanism are available to regular investors. Portfolio loans, where you borrow against your investment account without selling your investments, are offered by most major brokerages at relatively low interest rates. Home equity lines of credit allow homeowners to borrow against the appreciated value of their homes without selling. The scale is different. The principle is identical. Now let us address the obvious counter-argument, because if you are thinking clearly, you are probably asking yourself why everyone does not just do this. If borrowing against assets is so powerful, why do most people still sell? The answer has two parts. The first part is that this strategy requires having assets in the first place, which requires the discipline to buy and hold assets over time rather than selling them whenever they appreciate, which is exactly the behavior this video is trying to change. It is a circular system that rewards people who already understand it and penalizes people who do not. The second part is that borrowing against assets carries real risk that needs to be understood clearly. If you'll borrow against the portfolio and the portfolio drops significantly in value, as markets do during corrections, the bank may issue what is called a margin call, requiring you to either repay a portion of the loan or add more collateral. People who are over-leveraged, who borrow too much relative to the value of their assets, can be forced to sell at exactly the worst moment to meet a margin call. This is how fortunes are destroyed, just as surely as how they are built. The wealthy people who use this strategy successfully do not borrow to the maximum extent possible. They borrow conservatively, typically no more than 20% to 30% of their total asset value, maintaining a large cushion that protects them from being forced to sell during market downturns. The strategy only works sustainably when the borrowing is disciplined and the underlying assets are genuinely strong. Let us connect this to something larger, because everything we have discussed so far connects to a fundamental truth about how wealth is built and maintained that goes beyond any specific tax strategy or borrowing mechanism. The core principle is this: cash is a commodity, assets are engines, and the wealthy understand that the goal is never to accumulate cash. The goal is to accumulate engines. As many engines as possible, running as continuously as possible, for as long as possible. Every time you sell an asset to get cash, you are converting an engine into a commodity. You are trading something that generates value continuously into something that loses value continuously. And unless you immediately convert that cash back into another equally good engine, which requires paying taxes, transaction costs, and finding an asset of comparable quality, you have made your financial situation worse, not better, regardless of what the number in your bank account says. This is the mental model that separates the wealthy from the merely successful. The merely successful person sees a stock up 200% and thinks profit. The wealthy person sees a stock up 200% and thinks engine running well. Do not touch it. The merely successful person pays off their mortgage completely and feels financially secure. The wealthy person looks at a paid-off mortgage and thinks debt equity money sitting in an asset that is not generating returns that could be deployed into a productive asset while the mortgage remains at a low fixed interest rate. None of this means you should never sell anything. There are legitimate reasons to sell assets when you need to rebalance a portfolio that has become dangerously concentrated, when an asset has genuinely deteriorated in quality and prospects, when a better opportunity exists that cannot be accessed any other way. The point is not that selling is always wrong. The point is that selling should be a deliberate, strategic decision with a clear plan for what comes next, not a reflexive response to a rising price or a desire to convert paper gains into cash. So what does this mean practically for someone who is not yet wealthy but wants to start thinking and acting like someone who is building lasting wealth? The first shift is in how you think about your assets. Stop measuring them by what you could get if you sold them today. Start measuring them by what they are generating and what they will be worth in 10, 20, 30 years if you never sell them. The stock position that is up 50% is not a profit to be taken. It is an engine that has proven it works. Let it keep running. The second shift is in how you think about cash. Cash is not the goal. Cash is the fuel you use to buy engines. The moment you convert it into an asset, a diversified index fund, a rental property, a productive business, the goal has been achieved. Letting it sit as cash after that point is not safety. It is waste. The third shift is in how you think about borrowing. Not all debt is the same. High interest, consumer debt, credit cards, personal loans, car loans is wealth destroying. Low interest debt secured by appreciating assets, mortgages on investment properties, portfolio loans, home equity lines can be wealth building when used strategically and conservatively. The difference is not the debt itself. It is what the debt is secured by and what it is used to accomplish. The fourth shift is in your time horizon. The strategies in this video do not work over months. They barely work over years. They work spectacularly over decades. The stepped-up basis benefit requires holding until death. The true power of compounding requires decades of uninterrupted growth. The buy, borrow, die strategy requires assets that have appreciated substantially over a long period of time. Every one of these mechanisms rewards patience and punishes impatience. If you need the money in 2 years, these strategies are not appropriate for that money, but for the money you will not need for 10 years, 20 years, or ever. These are the principles that determine whether you leave your children assets or leave them nothing. The wealthy do not sell their assets because they understand something that most people spend their entire lives without understanding. The asset is not the means to the end. The asset is the end. The cash it generates along the way, the dividends, the rental income, the business profits, that is the means. That is what you live on. That is what you borrow against. That is what funds your life and your opportunities and your next investments. The asset itself, the engine you protect, you grow it. You pass it on. You never, ever convert it back into cash unless you have an absolutely compelling reason and a clear plan for what comes next. This is the wealth mindset, not a mindset of sacrifice or deprivation, a mindset of permanence, of building things that last, of understanding that the greatest financial decision you will ever make is not what to buy, it is what to never sell. Now you understand why the wealthy never sell their assets. The question is, what you are going to do with that understanding. If this video fundamentally changed the way you think about assets, wealth, and money, hit that like button and subscribe. We post every week with content that goes this deep on how wealth really works. Drop a comment below. What asset do you own right now that you have been thinking about selling? I read every single comment. See you in the next one.